Okay, greetings, Mr. Lamb. I am Shamika Levins, a first-year professional MBA student from Tampa, Florida, and it's a pleasure to have you here with us today.
Good morning. Good morning.
So my first question for you today is, why are most people investing in bonds?
You know, bonds are, like any investment strategy, part of a portfolio. So really, in my business, different investors may be looking for longer durations, more reliable returns. Some investors are willing to take a little bit more risk. They don't need liquidity, and they might not necessarily be looking for tax advantages. And so bonds offer investors some of those alternatives, particularly around their tax strategies. That's been a fairly popular one for years in terms of why folks invest in bonds. The other one is in a very stable interest rate environment, bonds can provide yields over and above what we've seen in the last few years in terms of traditional savings accounts without some of the uncertainty that we've seen in the equity markets. Now, more folks are moving to the equity market, so it'll be interesting to see what happens to bonds here over the next year or two.
Okay, so it's safe to say the higher the risk, the greater return?
In most cases, that's how it's supposed to work.
Okay.
I would tell you, that's typically how portfolios are developed, by looking at asset allocation, looking at the risk profile of an investment, and the expected return should align with that. Now, we've been in a very I would say, customary environment the last 5 to 7 years where not always does the higher risk asset yield the best return, and which is again another reason why we've seen some of our clients move into the bond portfolios. But I think we're getting to a more normalized yield curve. I think we're getting back to an equity market that's performing pretty well, so you may see the traditional investor come back.
Okay, thank you so much for that answer. My next question is, when does the bond actually mature?
Well, there's lots of durations for a bond. Typically, a lot of what we see are very long-term, 10 plus years, 20-year bond maturities. I would tell you, you can align the maturity of the bond to what the investor's time horizon is looking for. What's particularly sensitive around that, though, is you got to make sure folks are willing to forego some liquidity if they decide to get into a bond investment type instrument. So the maturity is important, but I think what's more important is understanding when you're talking to a client, what are they expecting in terms of not just return, but liquidity, risk profile, and their asset allocation in their portfolio. If you can understand those things, then you can match bond maturities to what their expected return should look like.
Okay. And how risky is the loan process?
The loan process?
Yes.
Well, the loan process is intended to not be risky. There are credit policies in place for both, whether they be bonds or whether they be true traditional commercial or consumer loans. That policy is intended to put up guide rails, if you will, that allows an underwriter to make decisions to extend credit, and it is intended to also allow a borrower to know what's expected of them. You look at simple, measurements such as ability to repay, track record or credit score. You look at an individual's, existing liabilities relative to their cash flow. And as you look at those measures, you're able to make a pretty good indication of the probability of repayment. Now, the last 5 to 7 years, we've had a lot of defaults around both consumer and commercial credit. Those are abnormal times, and credit policies are intended to operate in a normal environment. And so I think what we're seeing is significant improvements in credit quality with banks and individuals and businesses. We will get back to a more normal state where we can make credit decisions that are less risky.
Okay, how do you guys recuperate from those defaults of last year?
Time heals wounds. So it takes a little while to get on the other side of some of the credit crisis that all banks and a lot of our clients and business owners have had to deal with. With time, you also have got to make sure you put processes in place so that you don't make the same mistakes. And so making sure we train our underwriters and our loan officers to better understand the risk profile of clients, making sure that we inspect on a more regular basis when we extend credit to someone the performance of that loan, And then also making sure we don't have a certain level of concentration risk in a particular segment. So we don't overcommit in a particular industry or a particular type of loan. So that if things do happen to perform poorly, we don't have as much risk as someone else might have. So those are some of the things we're doing.
Thank you for that answer. And my last
And
question.
that's all the time we have.
That's all we got?
Yeah.
That's all we got?
That is it.
Was that
Oh,
helpful?